hope you guys are ready for some very interesting action going into the rest of the day today. As expected and as I've been outlining for you guys for a long period of time now, there hasn't been much going on. There have been some very, very interesting moves kind of across the board in some interesting sectors. Like you guys saw this net move. I'm not touching anything pre-Fomc. But anybody that was able to grab this one, again, that is another absolutely epic move there. But we're in the chop phase here, guys. It's been that way really since October here after I started outlining for you guys that it didn't make sense to really be taking on any additional risk in the market. And like I tweeted out today, it's like step one in the market is being able to identify how to read a chart and how to actually make money. But step two is understanding when the market is telling you when the times are to just sit on your hands and not really be too active. And if you can't follow step two, well, step one becomes very irrelevant because you'll just chop yourself up. So, ladies and gentlemen, we're going to have a very interesting afternoon here. We have the Summary of Economic Projections, I believe, is coming out at 2. The prepared statements coming out at 2. And then we are going to be getting the press conference with Jerome Powell at 2:30 p.m. Eastern time today. So it'll be very interesting. And as always, ladies and gentlemen, make sure you guys are hitting that like button on the way in. Costs you nothing to do it, but it helps me out a whole lot, spreading these streams out to as many people who actually want to learn. If you're not subscribed yet, make sure you guys are. It's going to be a very interesting next couple of weeks. I still think that time frame that I've been outlining for you guys on like mid-April, kind of going into May is when we could see things kind of get back to normal. But I do think we're going to see, like I've been talking about, the potential for more downside coming before that actually ends up happening. But what's interesting about this market right now is that we have had some very bad pieces of news. Escalation in the Middle East, oil prices doubling effectively. And the market has not really been able to make a meaningful push lower here. I mean, we're down, what, off of the highs here? Like 5%? 4.6% off the highs right now, guys? What is that, a sell-off for ants? But we are seeing some individual names in certain sectors getting hit very, very hard. So, like I was talking about on the private stream this morning with the LTMP group, like the amount of opportunity that's gonna come in this market over the next couple of months here as things start to balance themselves out are gonna be absolutely insane just because of the big drawdowns that we've seen. Net is just an absolute on a rager right now. So, but let's see, again, we have a 200 like goal on the streams, guys. Let's see if we can hit it. There's really not a whole lot of news coming out today. We're really just waiting around for what's going to happen at the FOMC meeting today. Let's see. Nothing really on the feed here. NEO, I believe, is still looking really good. Yeah, NEO looking great at the highs here, only down about, what, 1% today, just forming that nice little post-earnings consolidation setup. SoFi had a lot of drama yesterday with Muddy Waters coming out with that short report, and then Anthony Noto coming up, stepping up, and making that $500,000 purchase, kind of reinsuring the investor base there. So that was pretty solid. Let's see. Any other tickers that you guys want to talk about, just let me know. We'll go through them. Any questions that you guys have about the broad market, let me know. But this is like very boring time. That's what this is. This is how the market is. It's something that everybody that has to, like everybody that wants to be a participant in the market has to get comfortable with. And it's what I was saying all of last year, like all of those, which we will see this again. All of like the 30-something thousand% trades I handed you guys in 2 months. The entire time I was like, you guys are all going to get spoiled right now because we're going to go into a period where everything's going to be slow for a while. And that's just how it works. That's why you have to learn how to capitalize on those situations in the market so that you can sit here like the rest of us and be like, yeah, I don't really care what the market's doing until it gives us everything that we need to see in order for us to be convinced that it's okay to put significant amounts of risk back on into the market, which is obviously not now. Let's see. I'm looking through the feed here. I haven't really seen anything useful. Yeah, nothing too crazy really happening. FTX Recovery Trust to distribute approximately $2.2 billion to creditors in the fourth distribution on March 31st, 26. Interesting. Interesting. Benny, stop. More volume. Turn it up. As loud as that can go. It's literally as loud as it goes. Let's see. Yeah, oil up. I mean, again, the stuff today with the Jones Act, people are making that a much bigger deal than it actually is. All that the Jones Act, like laxing the Jones Act does is it makes the cost of transportation a little bit lower. It doesn't actually do anything to the cost of oil, and it allows like the use of U.S. ports by non-U.S. ships and nations. So it might help a little bit, but it's not really any meaningful effect. It's why you're not seeing oil prices react the way that a lot of people were potentially hoping off of that level of news. It was something we talked about last week too in the videos, where it was like, that's not really going to do anything. It doesn't change anything about the overall supply and demand, especially if 20% of the world's oil is coming through the Strait of Hormuz. So it's not really going to do much there. Yeah, really just going to be slow until we get Powell. We'll have a lot of things to go through. The main thing that we really want to hear about, because this situation is a lot different in some senses than what we were seeing back when we saw the FOMC meetings, when all of these new tariffs were coming into play. Because the main argument around the tariffs and what the Fed kept citing was, oh, it's going to be really inflationary, and we have to be careful with moving our policy. Their policy rate, because of the potential for inflation to start roaring back up. Now, the problem now is that we're in a very similar just overall situation where the Fed is going to be cautious, but in this case, we're already seeing the effects of this action on the oil market, which is going to push up the inflation metric, CPI, PPI, PCE. So it really depends on how the market is going to react based on the caution that we know the Fed is going to give us. GLW, let's see. No, I don't like that. And then Neo. Well, if you get a setup here on Neo, sure. Just follow what I teach in LTMP. It's super simple. If we get a textbook setup here on Neo, that could be a really good spot to enter. But you don't want to just blindly buy something that's up since earnings, 20%. So I wouldn't say right now. But like I was talking about, congratulations that you were listening down at those lower levels here. About what we were talking about with Neo. It was going to come down, flatline at this range here. Maybe it baits lower into this zone, but we have a good area of support in here. It's looking good so far. I mean, I own it at 455? So yeah, if we get another setup, we're good to go. If not, we'll just leave it be, It's looking great right now, though. Neo has done that last earnings, in the announcement of them having their first profitable quarter ever, was everything that I needed to see to keep me involved in it and continuously paying attention. They were finally able to execute, which is good. I want them to kill this market. I really want them to have 3 days of this, just dead, dude, nuke, just sell it off really hard. Not nuke in that way, obviously, but really, really aggressive selling off here. Just get this out of the market system. Where's software today? Software still holding on? Yeah, software still looks okay. How is crypto? As long as Bitcoin can hold the 10 here and not just really sell back down to the bottom of this range, you're fine. I mean, it's still going to be in a good area here for a potential continued move up. Down like this on the day today, though, after nice moves up over these highs, is not really what you want to see. But you can kind of still remain intact if it holds the 10 here. If it doesn't, then it's probably not going to work. Jack's dad, what's up, man? How you doing? Target downside looks nice. Let's look. It's tough either way because that does look good. Yeah, rolling over here. I bet Wally probably. Yeah, Walmart doesn't look good either. So Walmart, Target downside, Costco downside as well. Salesforce, let's look. Nah, not really. Not really anymore, kinda. I mean, Net has been the best one, especially after the news today. That thing is on a ripper still. Oh my god. It's still, though, it doesn't make sense to touch anything before FOMC and with all the other crazy stuff that we have going on right now. Like I say all the time, sometimes the smartest decision, which has been the smartest decision a lot recently, is just to sit back and do nothing. If I wasn't doing all this stuff with you guys, I would not be looking at this market at all. Zero. It's just going to be silly for a little bit. There's no reason to just be, staring at stuff all day long when, we know what the situation we are in is and what is most likely going to come of it. They're probably going to pump it in the summer just for midterms so they can talk about the market and do some other, it's It's the same playbook. It reminds me a lot of last year. This whole move that we've seen at the beginning of this year of Q1 reminds me a lot of last year. It's like 2 years in a row of very, very slow starts to the year, and then it picks itself back up. But this is a little different because you actually are most likely going to see a spike in the inflation data, which it will potentially set up a bond trade if we can get going in if the market overcooks these expectations, which they always love to do. Let's see, we got about 20 minutes until that decision comes out. But yeah, there's not much going on. Very slow. Very slow, sitting back, relaxing, and being bored. Yeah, coin I think is moving right now, isn't it? With net? Yeah, coin's starting to move back up here with net. Because Coinbase is, what was the news on it? It was Coinbase and net. Coinbase vies for Cloudflare stablecoin deal to power AI agent payments. That's interesting. And then I'm still hunting this SCO idea, this short oil. It's not there yet. It's not quite there yet, but it will get there. I like that it's making new lows and oil isn't making new highs. NVTS. This right now does not look like it's going to move back to new highs, no. Not a great looking chart here. Decent setup in here and a nice break, but a lot of these breaks are getting sold into, which is why I keep telling you guys, like, it's like you could have like great looking setups, and that's where the market becomes dangerous, because then you're like, oh, it just looks good. It's like, no. That's why I say to you guys all the time, it's like you can't just put like a little cookie cutter setup onto the chart and then hope it's going to work all the time. You have to understand the context that we're in, which is why it's like, especially going into this week, I was like, yeah, there's not really much that I'm interested in. Why would there be? And it really, this type of market really exposes like who is in this game for like quick short-term wins, things like that, or who is like really interested in learning about the market and becoming like an actual market participant and understanding that it takes a long-term vision to crush it in this game. Selling puts on SCO. Okay, Reaper. I mean, I would do it now, honestly. Sell some like 750s. Because remember, I initially wanted this thing at like 860 for a flip over 10. I mean, it hit 1130. I just couldn't get it. Wouldn't let me get it. But yeah, like these periods in the market, guys, like I know a lot of people are probably out there very frustrated about what they've seen recently. It's like, it shouldn't be. Because we all know what happens next. It's like we should be I want the market, I want SPY to go down to 600. So until the next rate cut, SoFi is going to move sideways? That's not what I said. SoFi doesn't move on rate cuts. It's part of it. But like SoFi is more so going to move with like risk. Just risk appetite in the market. Which is, there's none of that right now. SoFi, Robinhood, Webull, Bitcoin, software kind of, are all going to move up when risk appetite starts to come back into the market. It doesn't, I mean, the expectations for more rate cuts could drive risk appetite, but it's not just the rate cut itself. It's very rarely actually the rate movement itself, unless it's a surprise that dictates action. It's always the market's expectations of what's going to happen next is what's going to dictate the action here. Like if the market just expected a bunch more rate cuts coming this year, I mean, it would probably be moving up. If the market didn't expect a lot more rate cuts, which is what we're starting to see based on the inflation data and oil moving up, then yields are going to start climbing up here and the market's going to sell off. It doesn't actually have to do with, like today, we're not going to see anything. It would be shocking if we saw a cut or a hike today. Very shocking. Do I think he'll cut? No. Why would he cut? Powell has no argument right now to cut. Powell did. This is the problem that we've seen. Like the Trump administration right now is just like the way that they're handling like the like they want the Fed to cut, okay? if you really want the Federal Reserve to cut rates, you don't take actions that's going to double or like, I don't know now, 50% increase in the price of oil. You don't do that. That's just dumb because like, okay, inflation's going to go up. The Fed has a dual mandate. It doesn't really matter if unemployment is going up that significantly, even though the Fed has said that they are going to more so manage the labor market than they are inflation right now. They're not going to start aggressively cutting because they can't. Because if they do, it just adds more fuel to the fire. And the inflation metrics. It's just stupid. Like, it's like really dumb for them. Because then watch today. Powell's not going to cut rates, and then you're going to see a Trump tweet about like, oh, Powell should cut rates. It's like, how does that make any sense? It's the direct action or Powell not being able to cut rates is a direct result of the policies that we've seen and the actions that have been taken. Why didn't we cut rates more last year? Oh, the Fed was worried about tariffs. Now, that was a bad argument because the demand side of it, but this is a little different because you did see oil rip. This was when I started talking about like getting long oil. I think I tweeted on the 28th. I was like, yeah, next big moves that are going to happen are in the oil space. Oil goes from 62 to freaking 119. Boom. Boom. We had USO just cruising. Look at this. Same time. Just rip city. 72 to freaking 118. Boom. But now after all that, nailing gold, nailing oil, Bitcoin, crypto was kind of that next area, and it still could do it. It's looking a little more shaky right now. But it's just all about the sector rotations and where the money is going. You know? So we got about 14 minutes here. And again, as you guys are filtering in, make sure you guys are hitting that like button. We have a 200 like goal on the stream. Let's see if we can hit it today. We might. We might. I'm looking for something useful for us, and I don't see much. The official said it was aimed at signaling to Iran that if it continues disrupting oil supply through the Strait of Hormuz, there could be an escalation in the targeting of its energy facilities and a worsening of the economic crisis in the country. Wait. So you better open up the strait because energy prices are going up, but if you don't, we're going to strike more energy targets and we're going to increase energy prices. Okay, cool. Nice. Is net still going? A little. I mean, it's at 225. That thing's ripping. I want them to just get this, just sell it off. I think that's how everybody's feeling now. It's just like, sell it off. Let it go down. Like, I'm kind of hoping for Powell the Hawk today to finally give us that, like, all right, we can break these lows, maybe somehow make that push down to 650, and then if we're lucky, we get down to that, like, 608. Because the buying opportunities there are going to be insane, and the trades that are going to come as a result of that, it'll make last year's, like, I don't know how many total we had last year, 50-something probably, 1,000% trades, it'll make that look like child's play. Mr. Bama, where have you been? I've been here all the time. That's why I say make sure you guys have notifications turned on for the channel. Don't miss this stuff. I've been good, man. I've been really good. AMD. I mean, it looks good bouncing off the 200 here. It's got a nice base. But again, it's like, are we really going to be looking for things on an FOMC day? No. No. Kind of where I'm at. It's just like I don't care. Like, market can do whatever it wants to do. It could rip back to the highs right now. It doesn't really change anything. And that's what I kept saying to you guys in here. Like when we were in this chop range, I was like, it literally doesn't matter. Selling off, running up. It doesn't change anything because you're going to see the same type of action across the board where the conditions are going to be kind of wonky. And that's why we've been focusing so much on post earnings. We had one of the craziest post earnings seasons in forever. Coin is actually moving up nicely here. Coin's looking for day highs. It's looking good. All right, 10 minutes to go until we get the, what do you call it? Until we get the prepared statement and I believe the summary of economic projections too, which the dot plot is going to be a major focus today to see what the shifts look like. Is the boat back yet? No, one of the boats is back. Oh, but AMD's got an interesting base here. I don't hate it. It's just FOMC day with all the wild stuff that we have going on. No reason to touch anything. If you gambled the net, though, and said, screw it to FOMC, I mean, that breakpoint was perfect. Yeah, nothing important coming through the news feed. It's just, I mean, I think oil's moving down off of, yeah, a little bit, but not in any really meaningful way just yet here. Yeah, AMD up nicely though. I like that. Yeah, we got 9 minutes here, and then we'll have a lot of more information to go through. Market's just been waiting all day for this. Let's see, is there anything on here? Yeah, nothing really. What's this? No. I mean, PPI was very hot. Yeah, it's like even with that hot PPI print, it's like we were barely seeing any moves in the market, and with where the VIX is, it's like everything's still so expensive, so you can't really do. That's why it's like this is like danger in the market. Like straight down, straight up is fine. This kind of rolling and choppy slowness is like where the danger comes, which is why I've been like just screaming for the rooftops. Just be cautious. Don't touch anything. Trade very small if you're going to touch anything. Trump administration expected to soon lift summer gasoline regulations to curb energy prices. I mean, they could do something else to curb energy prices too, by the way. There are other options than like lowering transportation costs and summer regulations. That's always an option. Here. Yeah, I'd love to see yields rip. Is gold still getting smacked today? Did it rally back up? It came back up a little. We were talking about this yesterday. This just looked like it wanted to roll over. Or maybe it was last week we talked about this, but I think it was yesterday again that we were talking about gold looking like it wanted to roll back over. All right, we got 6 minutes. Then we'll have the Q&A at 2:30. That'll be very interesting. I can't believe they're actually doing this. The Poly Market's up announcing the Situation Room, world's first bar dedicated to monitoring the situation. That's just they just have too much money. Like they're like, oh, we're gonna open a bar. Why? Nah, for the memes. Okay. All right. Nvidia back up. Coin's moving again here. I mean, this is still a beautiful looking chart here on coin. It's just been choppy like we expected. Bitcoin's holding the 10 right now. I mean, that's fine. As long as it holds above there and doesn't like really start making an aggressive move down to like the lower end of this range here, you could still see that bid come back into crypto. Which, to be quite honest, it's still like the fact that it's held so well and actually traded higher ever since the escalation in Iran. It's a very, very strong sign for crypto going into the summer. Like, yeah, obviously you're going to see some, like, short-term volatility here with all the crazy stuff that we have going on, but that's a lot of strength, especially with the market doing what it's been doing. All right, we got a little less than 5 minutes here, about 4 minutes to go. Let's see. Ooh, a lot of slackers on the like button. Slackers. Let's see. But, yeah, make sure you guys have notifications starting off the channel. I'm still making a lot more YouTube videos so you guys don't miss them. Robinhood's adding a social feature to it. Oh, that's gonna be wild. You want to enter RL? Why? Is it a good chart? It's really not what we want to see. It's just wonky. You know? Yeah, it's just wonky. I don't know. I never look and be like, oh, I want to trade this. It's like, no. If it makes sense to trade that, then we'll look for something, you know? Net still cruising. Coin starting to move. I mean, that's interesting. So 3 minutes here until the interest rate decision, which is going to be, I highly doubt they do anything. If Powell hikes, it would be kind of funny. Not going to lie. If Powell somehow, which doesn't make sense to, but if he did, I would laugh. I'd be like, thank God, now we can sell off to like 615 in this buy. We'd see limit down. And I'd be like, thank God. Finally, get all this nonsense out of the market. Which he's not going to do. But like, best case scenario, which sounds counterintuitive, would be a big sell-off over the next 2 weeks. Because then you line up with exactly what I've been saying about kind of mid-April going into May is when the market gets back to some sort of like normal area. But if it like rips back up into here and chops around at like 680 until then, it's like, it's going to get pushed out. Minute 45, here we go. He's not. I highly doubt he's going to cut either. I think we get a dud on the decision, and then it's the dot plot that people look at, and then overall Powell's tone in relation to the questions that he gets. Coin's moving there. If the FOMC doesn't rip down, you might get coin back into the green to them. All right, about a minute. About a minute. Here we go. Come on. All right, 20 seconds. Here we go. It's about to get interesting. Here we go, folks. Here we go. 10 seconds. 5, The AI is working. Yeah, it looks like it did. Fed leaves rate unchanged. No way. Shocking. Shocking behavior out of the Federal Reserve. All right, let's see what else comes through the feed here. Anything significant? Net ripping. Oh my lord. Look at that thing go. Would have been nice if we didn't have Powell today. Coin moving. Where's Powell here? It still looks good. Oil down a little. It's a dud. Just like, for now. I mean, I don't really see anything here. All right. Says implications of Middle East developments for the U.S. economy are uncertain. Inflation remains somewhat elevated. Economic activity expanded at a solid pace. Job gains have remained low. Unemployment little change. Vote was 11-1 with Mirren dissenting in favor of a 25 basis point rate cut. There you go, Mirren. Let him know. Fed says it's attentive to risks on both sides of its dual mandate. So basically a nothing burger. When Trump tweet? That's what I was saying, Michael. Like a final FU, he wouldn't do that though. He doesn't really have the argument to hike right now either. So yeah, we got a dud. We got a dud so far. The Q&A will be still really interesting. I just want to see if there's anything else coming through the feed here. Fed says implications of the Middle East developments are uncertain. Mirren dissents. Sticky inflation. Let's see. Inflation forecasts were revised higher, 2.7%, while unemployment holds at 4.4 and growth edges up slightly. Yeah, so they're just kind of going on pause. That's what they're doing. Continuing to be on pause. Net, what a freaking move out of that monster today. What did yields do? Yields came down a little. Yeah, can we just like break to new lows, sell it off? Powell says something crazy. I don't think so. We haven't really had like a super eventful FOMC meeting in a little while. Market's been pretty good at pricing in the moves. What else we got? All right, dot plot. End of 2026, unchanged. That's good. Implies 25 basis points of cuts in 26. 27 is unchanged. And then another 25 basis points of cuts in 27. Longer run, 3.1, previous 3.0. 7 policymakers, this is what's important for the market. 7 policymakers say no rate cut in 2026. One sees rates higher in 2027. End of 2026 PCE 2.7 versus previous estimate of 2.4. Core PCE 2.7, previous 2.5. GDP growth 2.4, previous 2.3. Unemployment 4.4, unchanged. Inflation expectations revised notably higher, which makes sense. But that's like them kind of like leaning on the side of like, oh, 25 basis points for the rest of the year or 0 is kind of what that's looking like. Because now if oil remains sticky up here, guys, it's not, you're going to get no cuts. Because, like, even if you see the unemployment rate stay where it is, or even it inch down a little bit, unless it starts aggressively moving to the upside, the Fed can't do anything. They're going to be like, well, all the data that we're seeing is like inflation is being sticky, the growth is fine, the labor market's fine. We don't really have to do anything. Net is still going. Oh my god. Powell's at 2:30. We just got the prepared statement though. Big nothing burger as expected. Big nothing burger. Which would, like, what did anybody else expect? Like, a cut right now? No. A hike? Absolutely not. It's like, okay, they're going to continue. And net is still going. Jeez. Coin, again, like I was saying, if Powell doesn't wreck this thing, you actually could see Coinbase move back into the green today. Where's Bitcoin off of this? I would assume it's rallying a little bit off these lows here, kind of holding above the 10. Yep, there it is. Little bit back above the 10 there. So it is holding on. Ooh, 11 likes away from 50. Thank you guys. We're almost a quarter of the way there to the like goal. Thanks, I appreciate that. And then, yeah, for those of you guys that want to come in and join us within the LTMP group here, I mean, I can throw that link for you guys in the live chat. Everybody, 2-week free trial. I mean, that's not going to last for very long. And then, again, once everything starts kind of heating back up, prices are going to go up significantly. So, again, for those of you guys that want to come in and learn how to be self-sufficient in the market, I tell you guys this all the time. It's like, it's finding the best trades in the market. It's not that hard. When you guys see, which you've all seen before, like the big 1,000%ers happening left and right, that's the easy part. The other part, which I think is the most valuable part of it, is when I come out and, like I have been saying, no, don't touch anything, because it allows you to preserve capital. That's the most important part of this game. It's like, if you want to have success in the market, you have to learn that, because it doesn't matter if you know how to make money or not. If you can't keep it, it doesn't matter. Secret charts. No secret charts. You know how much you need on your chart? Nothing. Maybe a 10 EMA and a 200. That's it. Yields moving down. Bitcoin's still holding. Yeah, very big dud for the FOMC meeting so far. But yeah, I think we're about a month away from back to normal. I think... See, this is the thing, like, about this market, and it's something I keep thinking about. It's like, okay, now you have a Fed that's going to be very cautious, which the market doesn't necessarily like. It obviously wants cuts. Now you also have this situation in the Middle East. I think the China meeting between the U.S. and China is getting pushed back. You have a really, like, hot inflation data, and if oil remains up at this elevated level above 90, you're going to continue to see hot inflation data, which is then going to fuel the cycle even more. And even off of that, the market is only down 4.5% off the highs. It's like very strange right now that the market is not able to make this big move down here. And also, we haven't even really talked about this that much, but look at where USD JPY is right here. Back almost at 160. That's the intervention area. See what happens when we get to these ranges here, guys? It's like boom, boom, boom. Like, they don't want the yen up, down that low, or USD JPY this high. An AI bot for $1,000 a month? What? No. No. I think a lot, like, I keep seeing this on Twitter. Like, people, they're like, oh, look, I made this thing. And it's like, you made nonsense is what you did. All you're doing is bells and whistling for people. That's what you're doing. The people that are falling into that, like, stuff, I see these, like, people who are just like, they're like, oh, I made this. And I'm like, yeah, but it just looks fancy. It doesn't do anything. It doesn't, like, they're like, oh, but it does. I see it so much on Twitter these days. You know what you should learn how to do? Understand the conditions of the market. Look at sector rotations. Understand how to find stocks that are about to explode before they do, which is really not that hard. Call it a day. That's all you need. Really? That's crazy. Microsoft? I don't have anything on Microsoft right now. Microsoft is drilling lower here. Microsoft needed to break what? Like this area? Never did? Yeah. Big dud. Everybody loves to overcomplicate the market all the time. They're like, what about this? And it's like, go find the good sectors, Just look at the sector ETFs, understand how to then find which stocks are about to explode in them, which will take you an afternoon of going through the videos in LTMP, and then you're good. And then once you learn how to read the overall market conditions, which literally could be as simple as, is it trading above is the 10 above the 20? You're done. The market is so much simpler than ever. Like, think about, like, everybody thought it was like some magic secret sauce when I was handing out to you guys like 1,000% trades every single week. It's because the market conditions are good. We're in the right sectors, and we're just waiting for that period again. That's all it is. So 20 minutes to go. Fig getting clipped there off of this Google stuff, I think. Is Adobe doing it too? Yeah. Where's IGV still? See, the two sectors that were looking the best are now kind of stuttering a little bit. So we got to wait to see how those are going to develop, which are crypto and software. Which we nailed the software bottom. There were some really epic trades off of that, like this ServiceNow one, just ridiculous off of this level here, this 111 all the way up to this 126. That was great. Oh my God, net is still going. I hope they just sell it off hard today. Just get it over with, market. Dovish Fed? I would not consider that. Yes, remember what I said before about the Fed's leaning on like one rate cut or zero? U.S. interest rate futures see 21 basis points of easing in 2026, which is unchanged. So, I mean, I would say that's good that the dot plot's not moving around a whole lot, but then it kind of brings us back to, okay, so nothing's changed. Now it's a situation of, is oil going to remain at these elevated levels? If it is, you're going to see an inflationary spike. If it doesn't, you're still going to see the effects of this. And it's how long are they going to last? And how is the market going to get through that? Because they could look at it and say, oh, it's a one-time spike. But, I mean, a one-time spike in oil, the way it's done, can have very, very not good consequences. Net new highs. Jeez. Where's coin? Coin, like I was saying, might do it. Needs another $1.40. Go green on the day. We got here 17 minutes. See, it's crazy. Even the FOMC was slow. Like, even the news that we just saw out of, like, the FOMC meeting was slow. Everything's kind of been slow this week. I almost think we're going to get... I mean, the Powell's going to get asked a lot of questions, but he's just going to be like, yeah, I don't know. He's going to be like, yeah, well, it's who knows? Oil might come down, it might not. If it doesn't, we're probably not going to do anything with rates this year and look into next year. But remember, then we're going to see a transition this year with the Fed in the summer. This, I think, has been the biggest dud of an FOMC candle that I think we've seen in a while. Like, it's really not moved. Let's see. Ooh, 2 likes away from 50. Thank you, guys. Appreciate it. So, let me see if I can pull up the... Just gotta make sure you guys can't hear it yet. I think we're good. AMD's looking good here. My baby. How's Neo holding on? Oh, yeah, that still looks great. That still looks great. SOLS. No, but I like the chart. Chemicals? Yeah. These chemical names have been doing really well. I mean, we can look through some of them. DD, ESI, PRM. I mean, they're going to be weird. You wouldn't want to... That thing's getting murdered. Yeah, so probably not a great area to look in. You'll see a couple big winners. Nuclear somehow? Yeah, a lot of the other uranium ones aren't really moving. Like CCJ, I mean, Quad U is more focused on rare earths right now than they are uranium. I mean, they're still focused on uranium, but there's a big rare earth build out with energy fuels. Oh, Datadog did something? Yeah, that's running right into the 200. What was I looking for? Oh, I know what I was doing. Something they do that no one else does? Oh, I haven't seen any of that. I don't know anything about that. Come on, sell it off. Baited to the lows there. Yeah, the 2027 dots are interesting. 1 expects a hike, 3 expect no change, 4 expect 1 rate cut, 6 expect 2 rate cuts, 3 expect 3 rate cuts, 1 person expects 4, and 1 expects 5. That's pretty crazy. Very, very divided FOMC. But yeah, this is nothing has changed. Like, nothing new has really come up today. It's not much to do. It's just boring. It's like, ugh. Can we at least have some action? Down, up, something? Not this, like, chop nonsense that we've been in? Do something, market. That daily candle on coin is going to look epic. If it closed here, it would, yeah. It looks great. Bitcoin's still hanging out at the 10. That can, I mean, even if it has a little bit of a green day, that'll fuel it a little more. But then, how's net? Net is just raging. See, those are the types of moves that we want. Right there. Net. Bang. Just wish it wasn't an FOMC day. All right, 12 minutes. Yields aren't doing anything. Like, it's such a dud. Yields coming up. Market selling off? A little bit. Netflix stuck. Yeah, but Netflix, again, is nothing right now. There's nothing to do on that. News will come out when Trump texts his disapproval of Powell's decision. Which, yeah, I mean, that'll probably come out in, I don't know, in the next hour. Powell getting Trump getting angry about no rate cuts. It's like going over and like slapping your buddy in the face, and he's like, "I'm not coming to your birthday party," and then your birthday party comes, and he's like, "Why are you at my birthday party?" And it's like, "What are you, nuts?" Like, market moving down. There goes coin back down. It's still looking like a great set. Like, this chart is just. This is the best chart I've seen in the market in a while. I mean, net was good too, but coin just looks ridiculous. Nothing coming through the feed either. This is so slow. I think people are just like, yeah, we don't care. I think that's what it is. Which honestly, that's how I feel too. Like this market, we're just gonna wait until it's ready to go. Median rate dot was unchanged. Yeah. PCE revised up, which is not great, but other than that, it's just slow. Is it a costume party? I don't think it matters what type of party it is. Is UMAX still moving? Yeah. Weren't we talking about this one down in here on the mastermind? 14? That was where we talked about this, right? In the mastermind session with you guys? That sucks up a lot since. Net new highs. Jeez. Or no, but it's close. Oh no. Yeah, that was new highs. This market can't get any more boring. Want some action. Do something. Up, down. Not this. This is just nonsense. It's just slowly grinding away to the downside. I hope Powell says something to push this lower, because if he brings it back up into here at like 670, I'm going to be like, oh my God, what are we doing? So should you buy gold? I mean, I have not talked about gold at once, and I gave you guys GLD at 317, so I'm not looking at gold right now. I have a healthy position in gold already, way down here, so that I would not be buying this. We were actually looking at the downside on this recently. Again, guys, there's a time and a place to be operating in the market. After you see, I don't know, what's our gold position on? 41%. That's not the time to be long in gold. You know? Like, why would it be? You'd have to provide a thesis as to why this makes sense to be buying gold here versus buying it when I was screaming it from the rooftops at 317, you know? So get GLD. Sure, get GLD. Sure, go for it. AMD's still looking good. I want to see them push this lower. You guys got to listen. When I say things like oil at 62 or GLD at 317, this is a common thing. We see this all the time, especially with like the trades that I hand you guys to in LTP. It's like the trade will already be up like 500% for people, and they'll be like, oh, should I buy it now? And it's like, no. No, gold doesn't make sense right now. Gold's got to come down, base out, like, I don't even know where I would want to get this. It's so extended. Like, I'm not selling my position that I have at the 317, but like, I wouldn't be buying it up here, you know? Like, what would be the argument for it right now? I don't see one. Strong dollar. Like, where's Dixie right now? Dollar's probably still strengthening. Yeah, dollar's still moving up here. Until we see signs of the dollar rolling over here, I wouldn't touch it. Here we go. Come on, break through those day lows, market. Get selling. Qatar dealing with fire in Ras Laffan caused by Iranian attack. Come on, market. Like, market's down 0.7% today. I just want to see what these premiums have done. I bet nothing. Oh, yeah, they're barely moving. Yeah, these are barely moving. That is not enough to want to take on any risk to the downside. All right, we have 5 minutes here until we get to hear from Powell finally. Nope, they don't want to let it go. We'll see. Maybe Powell says something. It's like we're trapped in purgatory here. Just big range since October. That's it. Four minutes. Now we can finally get some action. It's just there's nothing going on. Second to last time we get to hear his wonderful. I think so. I'm gonna miss Powell. He's had to deal with a lot. from like what Powell's had to deal with. I mean, he's done a pretty decent job. Yes, they made mistakes. From the hand that he was dealt, I mean, he did all right. Oh, we're going to print all the money in existence. Okay. Figure it out, pal. He's like, all right, I was not prepared for this one. Is it going to be a bloodbath? It's a dud right now. Kind of as expected. Everything came out the way that the market thought it was going to. The PCE projection is a little higher. It's 20 bips higher, so that's not great, but that's as a result of the oil spike. Market's putting me to sleep. It's just so boring. It's like, oh, good setup. Yeah, we're not really going to be looking at it, though, are we? You know? All right. Hopefully Powell says something interesting, but it doesn't seem that way. Net just on a rager here still. Oil down. Bonds not doing anything. Dollar not really doing anything. Bitcoin barely holding on to the 10 here. Minute 30. Here we go. Here we go. Make sure you guys are hitting that like button on the way in. It'll be interesting to hear from Powell. But I mean, it still looks like we're going to get a dud. This is one of like the lowest volatility FOMCs I think we've seen in a while. Especially off of that, like and with everything that's going on. It's just straight. It almost though, with the way the market's just be like reacting generally, it kind of makes sense. Like, if they weren't going to sell it off of oil going up to 120 almost, you got the escalation in the Middle East, inflation's going to spike, the China meeting getting pushed back, like, not great earnings in some of these companies, semis rolling over a little bit. You got, like, it's like, okay, what's going to cause it, you know? TWI? What's TWI? Yeah, I don't remember this, but you're welcome. There you go. Nice. All right. Waiting for Powell. We're gonna get him in within the next minute here. All right. Let's see. Here we go. Oh, here he is. He's coming out quick today.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months, and inflation remains somewhat elevated. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. The implications of developments in the Middle East for the U.S. economy are uncertain. We will remain attentive to risks to both sides of our dual mandate. And I'll have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5 to 3.75%. From last September through December, we lowered our policy rate 0.75 of a percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Thank you. Colby Smith of the New York Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So, first, let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time. And that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net we didn't make progress. And if you look at total inflation, total core inflation, it's about 3%, and some big chunk of that, between 1/2 and 3/4, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind, and the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the S&P, can you help us make sense of why there is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? Just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so there are 19 people, and so 19 reasons, 19 individual submissions. And if you notice, the median didn't change, but there was actually some movement toward a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut. And each person has individual, stories behind what they want to do. But essentially it is that, the forecast is that we will be making progress on inflation. Not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs, going through once and then tariff inflation coming down. We should be seeing that. And, the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
Thank you. Howard Schneider with Reuters. Just to follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it. But, that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen, the progress that we had hoped for on core goods. And on tariffs and on the rest of it. So for whatever reason, people did write up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil, but it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
Right. And is the lack of change in the SEPs, again, just to explicate this a little bit, it more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, diverting spending from other parts of the economy?
So I didn't get the second part of your question.
That consumers are going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending there that can hit consumption, wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts to slow?
So the thing I really want to emphasize is that nobody knows. The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction. To your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass-through. So people write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one, because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just you got to write something down, and this is something that is that people wrote down. We don't debate how long. How do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement. And also, what you've written down before you'll be reluctant to move too far away from that, just because you don't know. It's so unclear what the direction from this particular end will be. Meanwhile, the growth has been solid, and inflation, the overshoot is mainly from the goods and tariffs. And, the labor market is, the unemployment rate, of course, is little changed since September. You have a very, very low break-even rate, apparently, for new jobs, with little growth in either demand or supply. But the U.S. economy is doing pretty well. It's just we don't know what the effects of this will be, and really no one does.
Steve.
Mr. Chair, in the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increases to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is there is, the original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So, sorry, your question was?
What the staff is saying about, and has said in the past.
Yeah. So there'll be an offset.
Offsets, yeah.
So that's true. We're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable, and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, a consistent rise in oil prices from where they were before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period of time, meaningfully higher. So I wouldn't say there's much of that happening. Not much will be happening now, but some of that could happen over time if you see that. But so the net of the oil shock will still be some downward pressure on spending and employment, and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that, having looked through tariff inflation and inflation running above target, and looking through the oil price shock, would undermine the credibility of your commitment to the 2% target?
We have to do our analysis and think these things through carefully, but of course that's on everyone's mind. We're well aware of the history, but you don't want to overreact to that. You want to make the best judgment you can based on the facts. I don't think we're going to let it color our decision-making more than is appropriate. It's more the thought that it's been 5 years, and we've actually had, we had the tariff shock, we had the pandemic, and now we have an energy shock of some size and duration. We don't know what that's going to be, actually. And, it's one of those things where it's a repeated set of things, and you worry that that's the kind of thing that can cause trouble for inflation expectations. And so we worry a lot about that, and we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%. And, I think it's important that we do that, very important.
Nick.
Nick Timoros, Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing services, not just goods, and the economy doing fairly well, as you just outlined, what gives you confidence that inflation returns to target over the next couple of years?
Okay. So I would say the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices the tariffs are paid by consumers, on a one-time basis. And we're waiting for that process. It takes 8, 9, 10, 11 months, a year to go through the system. And we're waiting for the tariffs, which were put in place over the course of the middle part and later last year. We're waiting for that to go through the system so that goods inflation will return closer to what it's always been. I mean, it used to be, for many, many years, it was negative. And then, the year before tariffs came in, it was 0. And it's running at like 2% now. So, so that's kind of, goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive, restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor market are to the downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates or not cutting anyway. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks, and we feel like where we are now, which is kind of on that borderline, the higher borderline of restrictive versus not restrictive, we feel like that's the right place to be.
Can I ask about core non-housing services, though? Because there are some people who think that it hasn't come down very much, if at all, over the past year. If wage growth has come down, if the labor market has loosened, why has non-housing services inflation maybe been slower to follow?
That's a good question. It's frustrating. Non-housing services they basically moved sideways for a year. They're at the same level, and we do expect that they will come down. But it's a bunch of idiosyncratic things. But at the same time, that is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services, but we're not seeing progress there. So we do, what we expect for next year is what we want to see for this year, rather, is continued progress on housing services, finally seeing that, the goods inflation come back down because the one-time effects of tariffs are through, and then also get some help from non-housing services. That's what we'd like to see. But it's a good question why we didn't see much of that last year.
Edward.
Thanks, Chair Powell. Edward Lawrence with Fox Business. So in December, we saw employment numbers revised down to negative 17,000. January revised down. February posted a loss of 92,000. Is the employment side a far greater risk than the inflation side? Because we are seeing inflation, CPI is close to 2%. PCE has ticked down overall.
It's really, I wouldn't say that. I wouldn't say that that's clear at all, that one is more at risk than the other. So you can point to the unemployment rate being stable. And, in a world where both supply and demand for workers have come down very, very sharply over the course of the past year due to immigration policy largely, a ratio is going to be a better thing to look at than job creation, for example. So, and the ratio is the unemployment rate, and it's been stable since September. So that tells you that. Inflation, you can we're at 3.0% core. Inflation 2.8% headline. So we've been well above the 2%, that amount, whatever it is, 0.7, 0.8, or a full percentage point above 2% for some time. And that's a concern. We need to get back down to 2%. And we need to keep focused on that, even though we do now face some new inflation from energy. So I'd be hard-pressed to say that one of them is obviously more at risk than the other.
And if I may, what happens if there's no Federal Reserve chairman confirmed on May 15th? Would you stay on?
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over with transparency and finality, and I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet, and I will make that decision based on what I think is best for the institution and for the people we serve. Figuring you probably were going to set the dominoes off there, Edward. And I'm not going to have any more to say on those issues, by the way.
Thank you very much. Claire Jones from the Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that, and to what extent do you think we're in a different place today? Thank you.
It's really hard to say until we see the situation, the actual situation. In some circumstances, that might be the right case. In fact, for example, if we do see the kinds of disinflationary progress that we expect to see due to tariffs that I mentioned, I think it's hard to say, and it will depend to some extent on the size and duration of the effects we're seeing on prices, and it will depend a lot on what we can see in inflation expectations.
And just one follow-up, if I may, just on the BLS report that was mentioned briefly there. It doesn't seem from the projections or from the comments you've made today about the unemployment rate and focusing on that your view on the labour market story, to a large part being a supply-side story, has changed despite the quite negative number in February. Would that be the right take, and was there anyone else in the room who thought differently, and that the February jobs report was cause for concern?
So I think you have to take the two together. In a way, the January report was a positive surprise, and the February report was a negative surprise. If you put them together, you get something in the middle, and I think you have to really, as you do, I'm sure, realize there was a strike and there was weather, and that's about 80,000 of the negative effect total on the February report. Notwithstanding that, so what do you see if you take a step back overall? There are a number of indicators that suggest a degree of stability, but the thing that I think good number of people on the committee are concerned about is just the very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job creation in the private sector. But actually that looks like that's about what the economy needs in terms of dealing with very, very low, non-existent, really, growth in the labor force, which, of course, we've never had in our history. So you've got a sort of a zero employment growth equilibrium. Now, that's balance, okay, but I would say it does have a feel of downside risk, and it's not kind of a really comfortable balance. So, we look at that, we see it, we get it, and I mean, everybody understands the arithmetic, and that's you can say the break even is zero, but nonetheless, it's something we're watching carefully, and so are concerned about. But ultimately, though, you can argue that it's a consequence of deliberate policy, which is really the changes to immigration. That's the biggest factor there, and but nonetheless, something we watch carefully.
Andrew.
Thanks, Chair Powell. The economy's experienced a series of supply shocks in the last few years, COVID, tariffs, 2 oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common, and does the central bank need to start taking account of the risk of supply shocks as a more common problem?
We did go through a long period where the shocks were all demand shocks, and so we've had a lot of practice thinking about supply shocks in the last 4 or 5 years, for sure. And it's just a very different thing, and a very much more difficult thing, because it does immediately raise the question of tension between the two parts of our mandate. But has the world changed? I mean, COVID is a one-time thing, right? This energy supply shock is a one-time thing. It's not because of some broad tendency or anything, I don't think. And the oil shock with Ukraine was also a consequence of military action. So I don't know that the world has changed in a way that there'll be more supply shocks. But there's people have written that paper and that speech a number of times. A number of people have tried to make the case that is the case. And in fact, we have seen more supply shocks in the last 5 years than we've seen in many years before that. It's a fact.
Okay. You said last year that the Fed was reviewing its communication strategies, including the SEP, as part of its framework review. Whatever happened to that? And I have like 5 follow-ups to that, but I guess, what would you change about Fed communications if you had the time? Thanks.
What happened about that was not much, and I'll tell you why. So, we looked carefully at many aspects of the SEP and of our communications, and there weren't any ideas that had very broad support on the committee. And you don't want to make a change to your communications unless you have the committee behind that. So we didn't really make any changes on that. I had hoped that they had some things that I wanted to do, but they didn't attract broad support, and we'd already made all the changes we made to the framework. That was a critical thing. So we didn't. And, I wish we had been able to do some things, but we didn't. So maybe the next chair will take a look. I'm sure he will.
Michael McKee from Bloomberg Television and Radio. The minutes show in January some members of the committee wanted to include a two-sided guidance on policy. Was that discussed today? And given the rise in the inflation expectations, how much support for a two-sided policy warning would there be?
So it did come up today. The policy the possibility rather that our next move might be an increase did come up at the meeting, as it did at the last meeting. The vast majority of participants don't see that as their base case, and of course we don't take things off the table. But you correctly characterized, what was in the minutes that several participants indicated, and something very much like that conversation did happen. What was your second question, though?
I was just one question there, but follow-up would be, there are a lot of goods besides oil that are trapped in the Strait right now, and a lot of supply chains getting snarled. How much concern do you have about whether, if this becomes an inflation problem beyond just oil, whether there's anything you can do about it or would do about it, given the efficacies of monetary policy?
You can worry about other commodities. You can worry about all of the ways that oil-related commodities go into manufacturing and that kind of thing. The truth is, it's completely out of our hands, and we just, like everybody else, we have to just wait and see what happens, and it'll come down to how long the current situation lasts, and then what are the effects on prices, and then how do consumers react and that kind of thing. Really, I wouldn't speculate in any way, and there's really not a lot we can do other than kind of watch and see.
Louisa. Afternoon, Chair Powell. Maria Luisa Capurro with Bloomberg News. I wanted to ask you, you've said longer-term measures of inflation expectations reflect confidence that the Fed will get back to its 2% goal, but there are some colleagues of yours who have pointed to higher dispersion in household service, in business service as well. So, and that they take as a signal that inflation expectations may be less sticky than in the past. I'm wondering if there was a discussion around that at this meeting across the committee, and what were the views of what is the state of inflation expectations and the risks from higher oil and gas prices.
So at this meeting, I mean, a number of people mentioned and staff briefed on short-term expectations having moved up quite a lot for reasons we understand well. But long-term expectations, you know, you can always find one that's troubling or some aspect of one that's troubling, but ultimately, right through this whole period, the overwhelming majority of the things we look to, including markets, including surveys of, you know, of the public and also of forecasters, they've all been pretty solid on longer-term inflation expectations being right where they need to be, consistent with 2%. So that continues to be the case. We didn't have a lot of conversation about that. I think everyone does agree that you know, we'll be watching those extremely carefully as we see the effects of the price increases come through from the conflict.
And still on how the discussion went across the committee, before coming to this meeting, there were some members who were like discussing the risks of a slowdown in growth and at a time of where inflation remains high. It really doesn't seem that most members are penciling in a slowdown in growth.
No.
But has there been any discussion of the risks of stagflation at this point?
So people actually wrote up their growth forecast by a tenth, and I think that's probably to do with just growing confidence in productivity. But sorry, and your second question was just.
If there have been any discussions about the risk of stagflation scenario.
Yeah, so as I mentioned, there is tension between the two goals, right? The upward risk for inflation and downward risk for employment. So, and that puts us in a different situation. You know, when we use the term stagflation, I always have to point out that was a 1970s term at a time when unemployment was in double figures and inflation was really high and the misery index was super high. Add them together, you get the misery index. And that's not the case right now. We actually have unemployment really close to longer run normal, and we have inflation that's, you know, 1 percentage point above that. So calling that stagflation, it's not, you know, I would reserve the term stagflation for, you know, a much more serious set of circumstances. That is not the situation we're in. What we have is some tension between the goals, and we're trying to manage our way through it. It's a very difficult situation, but it's nothing like what they faced in the 1970s, and that's, I reserve stagflation for that, the word for that period. Maybe that's just me.
Elizabeth.
Thanks so much. Elizabeth Schulze with ABC News. President Trump says that oil prices and overall inflation will go down very rapidly as soon as the war ends. Do you agree with that?
I don't have a forecast on that.
When we're thinking about the impact on American households, as you know, they've been facing these higher prices for years. They've seen an almost $1 increase in gas. How worried are you about households, especially lower income families, being able to afford those price hikes? And should people be bracing for higher costs, including for food now?
We don't know how big these effects are going to be, and I don't want to characterize them in any way. Of course, people are already seeing gas prices. Gas prices are up almost $1 a gallon. We hope that isn't for a long period of time, and of course people will feel that, but I don't want to speculate about what that might mean, because honestly that would sound like I have some idea of what's actually going to happen, and I don't think anybody really does. We're going to see how this works out, and I just would leave it at that.
Victoria.
Hi, Victoria Guido with Politico. I just wanted to ask, for purposes of the next meeting, how the Middle East war develops between now and then, how are you thinking about what might guide action at your next meeting? I mean, if we have oil prices, above $100 a barrel the entire time until the next meeting, is that going to change your wait and see stance? Like, what would lead you all to move, or are you on hold pretty indefinitely?
We'll have to wait and see. I mean, we always say we're going to learn more by the next meeting, and usually we do, but in this case, we're going to learn a lot because we're going to learn 6 weeks to the day till the next meeting. And, we're going to see whether what happens is it's going to be very important for the way the economy looks and the way the outlook evolves with what happens in the Middle East. That's going to be a big factor, and we'll know that then. I don't know how it's going to affect our thinking. I really don't. And we did talk about alternative scenarios a little bit, but it's just I wouldn't bring that in here. It's very uncertain, and I just want to remember that we don't know, and we shouldn't assume it's going to be one thing or another. We're going to see.
So is it a matter of you don't know how the situation itself is going to evolve, or even if things remain as they are, the economy could still remain relatively durable in face of them?
Yeah, that's true too. No, I mean, the U.S. economy has just, made it's been strong through a whole bunch of challenges. I mean, if you go back to 2023 when we raised rates a lot in 22 and 23, and close to 100% of economists called for a recession, which didn't happen. In fact, 2023 was a really strong year. So the U.S. economy has really been just doing pretty well through a lot of significant challenges over the past few years. It's been amazing to see. And I don't know what's going to happen in the next intermeeting cycle, and I don't know what's going to happen in the Middle East. I wouldn't want to speculate.
Hi, Chair Powell. Thanks for taking our questions. What makes you so certain that tariff-related price increases will be a one-time effect? I don't think we've seen you since the Supreme Court tariff decision, and it's pretty clear that none of us know what the extent of the tariff shock will be as the administration moves to replace some of the tariffs that were overturned. So I suppose I'm curious, what would make you question this certainty that tariffs are going to be a one-time price effect?
Well, I would not at all use the word certain about my views on that. I'm not certain. I'm uncertain. But just if you think about what it is, it's a one-time increase in the price of a good, right? And what inflation is ongoing increases in prices this year, next year, the year after. That's what inflation is. It's not a one-time price increase. There's a very, very big difference. The public doesn't really focus on that, but that's the difference. And tariffs should be in theory, unless they cause people to start expecting still more tariffs the next year and still more tariffs the next year, they should be a classic one-time thing. People say the same thing traditionally about an energy price spike, because traditionally prices go up and they come back down. And by the time monetary policy would react, it would be over. So I don't have tons of confidence on that. I mean, I think that the theory is probably right, but as usual, the time it takes to get all the way through the economy is just very uncertain. And we found that coming out of COVID, that the inflation did go away, and largely for the reasons we thought it would, but it took 2 years longer than we thought. So I think we have to be humble about knowing how long it will take for tariffs to go all the way through the economy. And so what we've been doing is, our staff's been doing, it's very interesting. They started off with just an estimate because there wasn't a real history, and then they've built, based on the history that they're seeing of tariffs coming through into prices, they can now have an arc. And for all the tariffs, they can say, well, so we have, I think, a slightly more confidence that we will see tariff inflation coming down, not prices, but you won't see further increases. And we should start seeing that more and more in the middle parts of the year. We do expect that. Now, you're also right, though, that the level of tariffs came down fairly meaningfully in the wake of the court decision. But the administration said they're going to get that rate right back up to where it was. So, and we assume that they'll do that over time. So that's how we think about it.
Thank you.
Hi, thank you. Chris Rugaber at Associated Press. You talked about the shortcomings of the SCP in this environment. I wanted to ask about or throw in an additional thing, which is the fact that it's happening before transition. Is there still some value, perhaps, in the public knowing what other Fed officials are thinking, the ones who will stay on for the rest of the year and beyond? And does that even handicap your successor in any way? Well, just in terms of having a whole committee expressing its views, is that something that locks them in for the rest of the year?
No. We never. The SEP is never. People are more than happy to change their SEP dots. They're no way bound by them. You know, it's your opinion at a moment in time, which can change based on events. You know, sometimes very quickly. So it never locks people in. You know, people are more than happy to be proven wrong in either direction. And so I just think we do it. And you know, I mentioned this was a time when it's very hard to do it. During the pandemic, we actually took one meeting off, I think. But you know, we don't like to do that just because it's hard to do. We should just keep doing it. But I just would say for this one, though, I think it's even more than usual good to take the forecast with a grain of salt, because subject to just very high levels of uncertainty.
Hi, Chair Powell. Brian Chung with NBC News. So you mentioned at the beginning of this conversation that you're well aware of the history of inflation running above target. It seems like that might be what's underpinning the affordability problem that we're hearing a lot about on Main Street. Are there any signs to you that that's impacting the psychology of the consumer, especially given that they're a big driver of overall economic activity?
I'm not sure what that's all about, but I'll tell you what I think and what we see in surveys, and that is, you know, there were big price increases all around the world, by the way. Everywhere in countries like the United States had basically the same kind of thing. It was a global inflation coming out of the pandemic, and everywhere people are feeling like real wages have been going up in the United States now for 3 years, roughly. But people are not feeling good about it yet, and it will take some years of positive real earning gains for people to feel good again, we think. But you're right. But when you talk to people, they do feel squeezed, and you know there are areas where prices are still going up, like insurance. Various different kinds of insurance are getting more and more expensive, and that's just catching up really from inflationary pressures that take a while to get to into the price. So we take it very seriously. We don't dismiss it at all. It's a very real thing from the standpoint of what people are experiencing, and you know what it does for us is, you know, makes us even more committed, if that's possible, to getting inflation back to 2% on a sustained basis.
How does the Fed's independence play into the ability to address affordability?
Well, independence is what allows us to do our jobs, and you know, stable prices is half of our mandate. It's one of our two mandates, the maximum employment being the other. I mean, look at every advanced economy that looks anything like the United States anywhere in the world, in a market economy, in a democracy, and you'll see, you know, pretty much central bank independence that looks a lot like, in some cases, stronger than what we have. But it's critical that we have that so that we can do the things when we need to do them to preserve price stability. And it's an accepted standard practice, and I think has a lot of support, certainly in Congress, which is where our oversight is in Congress. And you see that among Democrats and Republicans in the House and the Senate.
Hi, Chair Powell. Richard Escobedo at CBS News. Thanks for doing this. Two questions. One, how high would oil prices and broader inflation have to go, and for how long, for the committee to consider hiking rates? And then secondly, diesel prices are rising faster than gas prices. How concerned are you that the increase in diesel might drive up food and goods prices and lead to broader inflation?
Yeah, I'm not going to give you an example or specific answer on the first question. You know, we're prepared to do what needs to be done, but I wouldn't want to hypothesize about what that might be. You know, in terms of diesel prices, So your question there is, are we concerned about it? I mean,
How concerned, and whether or not it will drive up, the cost of food and other goods that really rely on it to
so
move
I think
across the
it's
country?
a more general concern than that. It's diesel prices because that's transportation of food and things like that. There are just lots of ways that oil and derivatives of oil get into the production and transportation of many, many things. So, and those, there are big effects in headline inflation, but things like that leak into core as well. And the effects may not be as big, but they're quite real and they're material. So we are aware of that and we're watching it, but we're right at the beginning of this, and we don't know how big we just don't know how big this will be and how long it lasts. It may or may not be something that really makes a big imprint on the U.S. economy. We're just going to have to wait and see.
Thank you.
Archie, for the last question.
Thanks very much. Just to sort of stare into the future for a little bit, I was looking at the longer run bits of the SEP and noticed that the growth estimate had been revised up a good chunk from 1.8 to 2, and the kind of long-term Fed funds rate as well. It'd be great just to hear, is that AI productivity or what's going on there exactly?
Yeah, I think it's just productivity. We actually started seeing meaningfully higher productivity some years ago, 4 years ago, 5 years ago, and that's not because of generative AI. We won't know for years what it's really due to, but it could be due to the kind of things that people did during the pandemic to economize and somehow become more productive because there was an incredible labor shortage. But I think economic forecasters are very skeptical of periods of high productivity because they're so rare and they're often revised away. And for many of us, I never thought I'd see this many years of really high productivity, and by the way, expect it to continue. And we haven't really started to see the effects of generative AI, and that should certainly contribute to that. So it's quite unusual, and it's this is the higher productivity is the thing that allows incomes to rise over time. And so it's a great thing. Was that your question?
Yeah, no, I was just curious what lay behind that. And just briefly on that as well to finish up, you hear the argument a lot, this is a sort of disinflationary story, and if you believe that productivity thing, that should also weigh down inflation over time, maybe then kind of pull down where rates end up. Do you kind of agree with that line of thinking, or do you think that's not how you should think about where the rates
I think you have to be cautious about that, in particular if you're talking about AI, about generative AI. So remember, in the short term, what's happening is we're building data centers everywhere, and that's actually putting pressure on all kinds of goods and services that go into building these things. So that's actually probably pushing inflation up at the margin. In addition, it probably raises the neutral rate. So in the near term, you're not looking at something that would immediately call for lower rates or that would be lowering inflation. Over time, though, sure, it can be if it's expanding potential output, which is what higher productivity does, then it actually can be. But I think it's an empirical question because it's really is the demand growing faster or slower than the supply side. And I think we just don't know that answer ex ante going in. We'll just have to wait and see. Thank you very much.
All right, ladies and gentlemen, that was one of the biggest duds of an FOMC meeting that we have seen in a while. Everything came out just exactly the way that we thought it would. No rate change, a little bit of a change to the inflation projections for this year. It was interesting that the dot plot didn't really move across the board, but again, market's selling off a little bit on this, not necessarily for anything in particular, but just because, again, if the market's not going to get good news in this environment, it's going to interpret it as then the same kind of level of bad news that we've had. So, folks, I'll be back tomorrow with you guys in LTMP at 9:15 a.m. So for those of you guys that still need to hop in there with us, 2-week free trial at the top of the live chat there, but very, very, very slow action across the board. There's probably not going to be much else to do this week unless we end up getting some really good news about de-escalation in the Middle East and oil prices move down and the dollar starts to move the other way. But yields are starting to move up pretty decently here. So I really wouldn't expect a whole lot to happen going throughout the rest of this week. Again, that patience that I've been talking about so much with all of you guys is coming in handy right now for sure. So, folks, have a great rest of your day. Not really much else to talk about with this one. Pretty big dud. We'll see if I can get a YouTube video for you guys today. Might wait for tomorrow. But other than that, guys, enjoy your evening. Peace.